You can't switch on a million GPUs you don't have the electricity for. That's the wall the entire AI boom just hit. Not chips, not even memory, but raw power. And everyone's reaction has been the same. Go buy the obvious AI power stocks, a nuclear utility, a turbine maker, a cooling company. But almost nobody does the one thing that actually matters. They don't follow the bottleneck all the way down. Because if you do, past the power plants, past the turbines, past even the transformers, it ends in a place nobody's talking about. One factory in America making one kind of steel that the entire power grid depends on. This is a choke point money alone cannot fix. So let me walk you down the whole chain, the 3 ways to play it, the one most people miss, and the trap. Because here, the demand is obvious. The winner is not. Start with the scale. Data centers are on track to pull around 945 terawatt-hours of electricity a year by 2030, roughly 3% of all the power on Earth, and still climbing. For 20 years, US electricity demand was basically flat. AI just snapped it back into growth. The grid was built for stagnation, and now it's being asked to sprint. So why can't we just build more power? Follow the chain, because each link is a tighter choke point than the last. First wall, the queue. Right now, roughly 2,000 gigawatts of new power generation is stuck in line, waiting to connect to the US grid. That is more than the entire installed capacity of the country, sitting in a queue with 5-year waits. You can't just add electricity. Second wall, even once you have the power, it has to step through transformers to reach the racks. And a transformer that used to take about 12 weeks to get now takes 3 to 4 years. Demand for the big grid transformers is up 274% since 2019. The orders are placed. The gear simply isn't there. Third wall, the bottom of the well. Every one of those transformers needs a special material in its core, called grain-oriented electrical steel. And in the United States, exactly one company still makes it, Cleveland-Cliffs. This isn't software you can copy, or a plant you spin up in a year. It's decades of metallurgy. That's the bottleneck, inside the bottleneck, inside the bottleneck. When people say just throw money at the grid, this steel is the thing money can't conjure. And the scramble to get around these walls is staggering. The biggest turbine maker, GE Vernova, is sitting on an 80-gigawatt backlog stretching into 2029. Its bookable slots are sold out through 2028. And turbine prices are forecast to climb around 195% by the end of this year versus 2019. The hyperscalers aren't waiting for the grid at all. Microsoft is restarting 3 Mile Island with Constellation. Meta signed for over 6 gigawatts of nuclear. Amazon parked a data center straight onto Talen's nuclear plant. And NVIDIA just told the whole industry that its 2027 racks will run on 800-volt direct current. A detail that matters more than it sounds. Hold that thought. So how do you actually own this? 3 ways. 1. The power producers. The independent nuclear and gas companies signing these deals. Vistra, Constellation, Talen. The cleanest AI needs power trade. The catch. They move on deal headlines, they're still cyclical utilities, and a lot of the good news is already in the price. 2. The turbine and cooling kings. GE Vernova, sold out for years. And Vertiv, the company that powers and cools the racks, with a backlog over $15 billion in earnings growing fast. The highest quality picks and shovels in the whole space. The catch. Everyone already knows it, and the valuation shows it. And 3. The side door, the one most people miss. Except here it isn't one pick. It's a fork, and it's the most important decision in this entire trade. Because the contrarian layer is the gear between any power source and the chip, and there are 2 opposite ways to bet on it. The first is the toll booth. No matter whether the electrons come from gas or nuclear, on the public grid, they all cross transformers and switchgear. So you own the toll booth, the gear makers like Eaton and GE Vernova's grid business, and at the very bottom, the steel monopoly, Cleveland-Cliffs. You're not betting on which power source wins. You own the choke point they all funnel through. But there's a second opposite bet, the bypass. Remember that 800-volt direct current detail? A company called Bloom Energy makes fuel cells that sit right at the data center, output power as direct current, and can be deployed in months, skipping the grid queue and the transformer wait entirely. Brookfield committed up to $5 billion to deploy them. Oracle signed for up to 2.8 gigawatts. If AI increasingly goes off-grid with on-site power, the bypass wins, and the toll booth gets quieter. Which is exactly the trap. The honest case against my favorite idea, the toll booth, is that bypass. If on-site, direct current power scales the way its backers claim, it sidesteps the very grid gear the toll booth thesis rests on. I don't think it bypasses it completely. Even on-site power needs switchgear, and Bloom is still early in burning cash. But you have to take it seriously, not wave it away. And there's a second trap on top of that. Overbuild. Behind-the-meter gas is booming, and if the AI spending wave even hiccups, the data centers that promise to pay for all this power can walk. And equipment orders are the first thing canceled. The counter-argument from investors like Janus Henderson is that the real risk isn't too much supply, it's too little, that the whole system is execution-constrained, not overbuilt. Both can be true at once. And don't forget, Cleveland-Cliffs is also a cyclical steelmaker with a car industry bolted to it. None of these are clean bets. So where do I land? I lean to the toll booth, the grid gear, and the steel, because it gets paid no matter which power source wins, and it even gets paid partly in a bypass world. I treat Bloom and the on-site bet as the high-risk, high-upside satellite, not the core. The demand is obvious, the winner is not. And here's the clean one-year test, so you can hold me to it. A year from now, ask two questions. Are transformer lead times still 3 to 4 years? And are turbine slots still sold out past 2029? If yes, the bottleneck held, and the gear makers kept their pricing power. If lead times start falling, or an AI spending wobble starts canceling equipment orders, that's your early warning the trade is rolling over. Because the lesson keeps repeating. The world keeps bottlenecking on the one physical thing software can't make for free. First the compute itself, then the memory stacked next to it, and now the power to run it and the gear to deliver it. Software is infinite. Steel is not. The other two bottlenecks in this series are on the channel if you want them. Tell me in the comments. Toll booth or bypass? Who gets paid? This is education, not financial advice. And these numbers move fast, so do your own research before you risk a cent.